Welcome to the Opening Bell Report.
Okay, let's just try to unpack this. It's February 5th, 2026. You wake up, you grab your coffee, you're scrolling through your watch list, and you see a headline that, it should make investors absolutely ecstatic.
You'd think so. The numbers are just, astronomical.
Right. A company, ONDS Holdings ticker is ONDS, just reported a revenue increase of 582%.
Which is, almost unheard of. In corporate earnings, you're happy with double digits. 500%. That's just wild.
It's the kind of number you see from some, viral crypto coin. They went from $1.5 million a year ago to $10.1 million. In a single quarter, the chart just went vertical.
Hockey stick.
But, and this is the giant but, the stock price. It didn't go up. It didn't even stay flat. It crashed, down 15% on the very same day.
And that's the ultimate market puzzle, isn't it? A huge divergence. You have this incredibly good news and then this, violent market reaction against it.
Exactly. So what is going on here? That's the mission for this deep dive. We're looking at ONDS Inc. And the big question is this company the next major player in AI defense, specifically drone warfare? Or is this, as some are saying, a financial trap for investors?
It's a really high-stakes question because the numbers are so jarring. You've got that $10.1 million in revenue on one side, and then you've got this scathing report that basically calls the company uninvestable.
Uninvestable. That's a heavy word. You don't just throw that around.
No, it's a death sentence if the market buys into it. So our goal today is to really strip away the noise. We have to look at the Superstock bull case and then the dilution bear case.
I love it. Let's start with the company itself, because honestly, until recently, if you said ONDS, I would have thought railroads.
And you wouldn't have been wrong. For a long time, that was their whole identity. They were a railroad sensor company.
Right. Monitoring tracks and trains.
Yeah, proprietary wireless networks for railroads. It's important stuff, You need to know if the switch is frozen, but let's be honest. It's not exactly headline-grabbing tech that gets Wall Street excited.
It's utility stuff.
Yeah.
Reliable, but kind of boring. So how do you get from checking train tracks to where they are now? The pivot seems extreme.
They pivoted hard. They've successfully remade themselves into a full-fledged defense contractor. They realized that the tech used to autonomously monitor 100 miles of track could be used to monitor a hostile border.
Okay, so when you say systems or monitoring, what are we actually talking about here?
We're talking about their Iron Drone and the Optimus drone-in-a-box system.
Drone-in-a-box. I like that term. It sounds like something you'd buy at Christmas, but I'm guessing it's not that.
Definitely not a toy. Think of it like an autonomous robotic base. It's a rugged, weatherproof box. The drone lives inside, launches itself, flies its mission patrols, perimeter, whatever, and then lands itself back on the box.
And charges itself.
It does. A robotic arm inside either swaps the battery or recharges it. The human element is almost completely removed.
So no pilot with a controller, just always on, eyes in the sky.
Exactly. Persistence is the key word.
Okay, that is very cool tech. But a lot of companies have cool tech. What really changed the game just this week, there was a huge acquisition on February 2nd.
Right. This is what I'm calling the kinetic catalyst. ONDS acquired a UK-based company called Rotron Aero.
Rotron Aero. Okay, so why does a UK company matter so much?
It matters because of what Rotron makes. They specialize in two things: heavy fuel engines and something called loitering munitions.
Let's pause on that. First, heavy fuel. What does that even mean for a drone?
It's a huge deal for military logistics. Heavy fuel means Jet A or JP-8. It's the same fuel a tank uses or a jet or a generator on a base. The military hates dealing with gasoline.
So your drone runs on the same juice as everything else. It simplifies the supply chain?
Massively. Rotron makes engines that run on this stuff, but it's the second part that's the real game changer: loitering munitions.
That sounds like a euphemism if I've ever heard one. Break that down for us.
Well, yeah, it's industry jargon. In plain English, they're suicide drones.
Suicide drones.
Or kamikaze drones, yeah.
Okay. That is a very, very different business from checking on railroad track.
Precisely. And that's why this is such a big deal. It's a complete strategic shift. Before this, with Iron Drone and Optimus, ONDS was in the business of surveillance.
They were the eyes.
Exactly, being the eyes. With Rotron, they're now actively engaging on the battlefield. They're moving from surveillance to kinetic attacks.
Kinetic meaning things go boom.
Correct. And from a business perspective, that opens up a whole different tier of contracts. Specifically with NATO and the UK Ministry of Defense, Rotron is already in that ecosystem. ONDS just bought their way in.
So they went from, hey, we can watch your trains, to we can supply NATO with autonomous attack drones. That's quite the transformation.
It is. And that takes us right to the bull case.
Yeah.
If you're looking at this stock as a buy, you're looking at the numbers behind this pivot.
Let's go back to that headline number. 582% revenue growth. From 1.5 million to 10.1 million in a year. That's just staggering.
It really is. And in the world of small cap tech, you hear a lot about backlog or pipeline. It's all promises.
Right. Vaporware revenue. We signed an MOU.
Exactly. A promise to maybe sign a contract down the road. But this 10 million, that's cash in the door. It proves the tech isn't stuck in a lab, it's being deployed, and customers are paying for it right now.
So the stuff actually works.
The stuff works, and the market is buying it. That's the heart of the bull argument. ONDS has graduated from being a science project to a real defense contractor.
And usually the big worry with fast growth is cash. Scaling is expensive. Startups die from cash flow problems all the time.
And that's the other pillar of the bull case. ONDS has a war chest. A massive one. Pro forma, after the acquisition, they're sitting on about $840 million in cash.
Wait, say that again. $840 million on $10 million in quarterly revenue. That seems way out of proportion.
It's a staggering amount of liquidity for a company this size. Most small tech companies are basically living paycheck to paycheck.
Right, they're one bad quarter from going under.
But ONDS, with $840 million, they have a safety net for years. More importantly, it lets them be aggressive. They can buy more competitors, more tech, just like they did with Rotron. They can try to buy market dominance.
So the bull case is exploding revenue, combat-proven tech, and a bank account big enough to steamroll the competition. Sounds almost perfect.
It does sound perfect on paper.
But
But
there's always a but. And here it's that 15% stock drop.
Yeah.
So let's talk about the bear case.
we have to. This is where it gets complicated. We have to put on our forensic accountant hats for a minute.
And enter the villain of the story, or maybe the hero, J Capital Research. They put out a report that just pulled the rug out.
That's right. J Capital is a short seller. Their business is finding companies they think are weak, betting against them, and then publishing why. And their report on ONDS was brutal.
Uninvestable and promotional. What are they actually accusing them of? Having all that cash doesn't sound uninvestable.
The core accusation is that ONDS is buying revenue.
Buying revenue. How? How do you buy revenue?
Well, that 582% growth, J Capital argues it's not organic. It's not just customers lining up to buy their drones. They say it's because ONDS went out and bought other companies that already had revenue and then just tacked it onto their own income statement.
Oh, I see. So it's like if I have a lemonade stand making $10 and I buy the pizza place next door making $100, I can claim my revenue grew 1,000%.
Exactly. It looks great on a spreadsheet, but did you actually build a better lemonade business? J Capital says no. They call it financial engineering disguised as organic growth.
But they still have that $840 million in cash. You can't fake a bank balance.
You can't, but you have to ask where that money came from. Did they earn it selling drones?
With revenue of only $1.5 million last year, I'm going to guess no.
Definitely not. They got that cash by raising over $1 billion in equity. And this brings us to the scariest word for any investor: dilution.
Okay, let's unpack this carefully. What does dilution actually mean for someone holding this stock?
Think of the company as a pizza. When you buy a share, you're buying a slice of that pizza.
Okay, I have my pepperoni slice. I'm happy.
Now, the company needs money. So instead of earning it, they just print more shares. They take out the pizza cutter and start slicing the whole pizza into smaller and smaller slivers to sell to new people.
So my slice just got smaller.
Your slice is still one slice, one share, but it represents a much, much smaller percentage of the whole pizza. If you owned 1% of a company 2 years ago, after all this, you now own a tiny fraction of that 1%.
So they're running a share printing machine.
That is the exact phrase the critics use. They argue it's a share printing machine disguised as a tech company. And all that cash in the bank just makes them look stable while they do it.
And meanwhile, the early investors, their stake is just getting watered down.
Precisely. And for all that revenue growth, you look at the bottom line. Are they profitable? No. They had a net loss of $7.5 million last quarter.
So they're burning cash.
They're burning cash.
Right.
Now, with $840 million in the bank, they can afford to do that for a very long time. But the bear argument is that this isn't a sustainable business. It's a wealth transfer machine from retail investors to the company's coffers.
It's a true battleground stock, isn't it? You have these real-world defense contracts on one side and this aggressive financial engineering on the other.
A classic high-risk, high-reward setup.
So for you listening, trying to figure this out, what are the technicals telling us? What are the key levels to watch right now?
Well, looking at the analysis, there are some very clear lines in the sand. The stock is in a fragile spot.
Where's the floor? The support level.
The support is testing the $9 to $9.15 range. This is critical. If it holds here, it suggests the panic from the short report might be over. The market is saying, okay, we hear the risks, but the tech is worth at least this much.
And if it doesn't hold $9?
If that floor breaks, look out below. The analysis suggests that dilution overhang, that fear of more shares, could push the price down to $7.
Ouch. Okay, what about the upside? If the bulls are right, what number confirms the trend is back on?
Resistance is up at $11.50. The stock has to get back above $11.50. If it breaks that ceiling, it tells you the market cares more about the revenue growth and the Rotron deal than it does about the dilution.
So we're stuck in this no man's land between 9 and 11.50.
Exactly. A holding pattern while the market digests all this conflicting information.
It's fascinating because it forces you to decide what you value more. The operational reality, the drones, the NATO contracts, or the financial structure, the share count, the cash burn.
That's the perfect synthesis. The 582% growth is real, the $10 million in revenue is real, but the $1 billion they raised from shareholders, the dilution, that's also very real.
It feels like the company is saying, trust us, we needed your money to build this war machine, but now the machine is ready.
And the short sellers are saying, the machine still loses money and you're just going to come back for more later. It's a brutal tug of war.
Which brings us to the bigger picture. This whole situation with ONDS. It feels symbolic of the defense tech space right now.
It really does. We're in this massive transition in warfare, moving from these big, heavy manned systems to cheap, disposable, autonomous ones. Suicide drones are the future of conflict. We're seeing it in the headlines every day.
And companies are just racing to grab a piece of that. It's a gold rush.
It's a land grab. And in the land grab, sometimes financial discipline goes out the window. You do whatever it takes to be the one left standing.
Which leaves us with a really provocative final question to think about.
It does.
In this new era of warfare, does it actually matter how a company grows? If the drone works on the battlefield? If it saves soldiers' lives? Does it matter if the company grew by invention or by acquisition?
The soldier on the ground certainly doesn't care. He just wants the drone to work.
Right. But does that share printing strategy inevitably doom the retail investor, even if the product is a huge success? Can you have a world-changing product and a failed stock at the same time?
That is the ultimate question. History is filled with companies that changed the world and went bankrupt doing it. Just because the tech wins doesn't mean your stock wins.
Something to think about before you place that trade. That's all for this deep dive. We'll be watching that $9 support level very closely.
Absolutely. It's going to be an interesting week.
Thanks for listening. We'll catch you on the next one.
Don't forget to like, share, and subscribe for more.